Howdy everybody and welcome to another stock analysis video. The markets have been completely in chaos within the past week or so, and I figured that now it is a great time to somewhat revisit some of the companies that we have already taken a look at, especially those in the tech sector. And what none other better than Amazon. Right now, Amazon's price is very cheap compared to what it was. And let's actually analyze and see if the current share price is actually within the ranges that we might actually want to buy it at. So with that said, let's get started with this video. Starting off, we got the ticker AMZN for Amazon, market cap of $1.4 trillion, PE of 55.78 with a share price of a whopping $2,852. Now, the reason why I'm highlighting the share price right away is mainly because of the fact that look at this drop, guys. Look at this. This is on the 5-day chart right here. And as of the 22nd of January, it has just completely collapsed all the way down to 2,900, and even then has still collapsed all the way down to the price that it is today. So this company actually went from $3,244 all the way up to $2,853. So looking at this current share price, this is pretty much telling me that, hey, this might be a good opportunity to buy. Now, obviously, this PE isn't necessarily saying that, but from what it was to what it is today, we are slightly closer, at least in my opinion, to a share price that we might actually buy it at, depending on our assumptions. So we're going to take a look at that in just a second. This company does not pay a dividend, so that means that all of their cash flow is going straight into reinvesting in themselves, making acquisitions, and paying down debt. Now coming over here to the fundamentals, we got the net income 5 years ago of $2.4 billion to 1 year ago of, look at this, guys, $21.3 billion. Guys, that is a massive increase of a whopping 100%, which is just it's just mind-boggling. And on top of that, guys, look at this chart. It is very smooth, and in fact it even is beating that of the trend line, meaning that if this remains, we might actually not even get this current year income as it stands. For all we know, this actually might be even higher than that. So something to think about when analyzing this company is that you may want to pay a premium for this, assuming that they actually might be able to increase their income, increase their cash flow the way it is. And guys, the fact that it's Amazon, you know this is a huge company, and people will be chomping at the bits to be buying this at a super cheap price. Next, we got the cash flow, and 5 years ago we got about $9.4 billion in cash flow to 1 year ago of almost $26 billion. Guys, that is an increase of 176% with an average 5-year free cash flow of $16 billion. And remember, they do not pay a dividend. That means that all of the $16 billion is for their own pocket, which is just crazy to think about. That they have this much money just available to just like use to do pretty much anything that they want. Next, we got the revenue. 5 years ago of $136 billion to 1 year ago of $386 billion. That is an increase, guys, of 184%. Again, another massive number, and this is just incredible to see. Next, we got our new metric, and I did this in my previous episode where I said I'm no longer going to show the total debt. I'm going to now show the total assets minus the total liabilities. This is essentially this graph right here. And the reason why I did that is because debt is just a subsidiary of liabilities. So there's no reason to just show the total debt. Might as well just show the total liabilities. And just showing that alone, it doesn't really tell you much. You want to be able to know if they're even able to afford it, right? Because you can have $100 in debt, and that could be a lot or not a lot depending on how much money you have on cash, right? So that's essentially why I'm doing the total assets. And currently, guys, their total assets minus total liabilities is $14.5 billion. This means that today they have, if they were to just liquidate all their assets, if they were to just like liquidate all their assets, they could pay off their whole entire liabilities and still have a whopping $14.5 billion left So at this point, they could just sell all their assets, pay off all their liabilities, and have zero debt if they so wish to do so. Their average total assets within the past 5 years is around $91 billion. Total liabilities about $84.7 billion, and the difference between these two averages is a positive $6.7 billion. Next, we got the shares outstanding, a metric that a lot of people tend to overlook. And you don't really want to overlook this, guys, because this tells you whether or not the company is diluting you or not. You want a company to be buying back shares. You want this number to be decreasing. Amazon, 5 years ago, of 477 million shares to today of 507 million shares. That is an increase, guys. It is a slight increase, around 6%, is a little bit on the high side. This isn't something that like they're just doing this to like pay down debt or something like that. I think they're mainly doing this because of the fact that they realized that, hey, our stock price was really overpriced. Let's just issue shares and get that money back, right? There's no point. People are just going to keep buying them up, and there really is no point in us bringing it down, since people are just going to keep bringing up the share price, right? So I think that's the main reason why they did it. Smart on them, though I would like for this to be going down in the future. But nonetheless, this is a negative metric. And lastly, we got cash and equivalents, and as of today, they have 29, almost, actually, no. It's essentially just $30 billion in cash and equivalents, with an average cash and equivalents around, again, $30 billion, which is just massive. Now, knowing all of those metrics, let's make a low, medium, and high assumption, changing the growth and keeping the required rate of return the same at around 10%. In doing so, for the low assumption, assuming a growth of around 30%, which I know this is a huge growth assumption. However, looking at Seeking Alpha, the revenue growth forward is around 25.42%, and the revenue growth year over year so far has been around 32%. So I'm gonna say around 30% growth rate within the next 4 to 5 years. This comes out to be a target share price, not adjusting for debt, of $1,896. For the median assumption, I'm going to assume 35%, because I think that they're actually going to be able to do significantly more, especially in the future with people buying more stuff online and all this stuff, right? So I'm going to go even a little bit higher, 35%. This comes out to be a target share price of $2,186. And for the high assumption, I'm just going to say 40% for the growth. This comes out to be $2,508. Now, adjusting for debt, however, we get a target share price of $1,783 for the low assumption, $2,073 for the median assumption, and $2,395 for the high assumption. Adding a margin of safety of 5, 10, and 50%, we would like to buy between $1,516 and $1,694 for the low assumption. For the median assumption, it's around $1,762 to $1,969. And for the high assumption, it is between $2,036 and $2,275, well, $76. Guys, the current share price is $2,852. So we're still above these target share prices, even the ones that aren't adjusting for debt, by around $300 at the highest assumption. However, let me just remind you all again, Amazon's 52-week high is $3,773. So this has fallen down by almost $1,000 essentially. And now this is the question that you gotta ask yourselves. Am I willing to pay a premium for this kind of company? This is Amazon we're talking about, right? This is the juggernaut of just the entire retail space. This company is huge, this company is massive, and it is just completely taken over pretty much the entire retail system, right? And not just retail, they're even extending to other areas of different markets. So for all you know, $2,852 might actually be cheap. Now, it's really up to you to determine that. Are you willing to pay this premium? Because in my opinion, you should be willing to pay for a premium if the company has a lot of potential. And in my opinion, Amazon has way more than enough potential, right? And again, this is something for you to determine. If you do not agree with my assumptions, maybe you think that maybe 30%, 40%, 35% is a low growth assumption, then I highly suggest you get this calculator and you make your own assumptions. You can find this calculator in my discounted free cash flow calculator video, and you can pretty much just make your own assumptions if you do not believe that they are correct. All in all, guys, personally for me, I would actually buy Amazon at this point, at least not the entire 2,852, but at least just fractional shares of it. Maybe put in like $500. At least for me, this is what I would do. I would put in like $500 for it, and then dollar cost average if it continues to go down, mainly because of the fact that it is Amazon. However, Amazon does not follow my investing strategy. So personally for me, I'm not going to be buying this because it doesn't necessarily follow my investing strategy. But do not let me deter you from doing whatever you want. But that pretty much does it for this episode. If you like, comment, subscribe. It really does help with the algorithm on YouTube. You can follow me on my new tech sites at BitChute, Odyssey, and Rumble, where in addition to my stock analysis videos and crypto videos, you will find exclusives as well. So with that said, peace out, and be on the lookout for the next stock analysis video.